What is going on, everyone? Welcome to another episode of The Function, where we are on our Finance Tuesdays. We're going to be talking about the sacred account again for part 2. And I hope you guys are having a great week. Hope you guys are getting a lot out of this. If you haven't already, make sure you like this content. Make sure you comment, share this with others, and subscribe as well. And in today's episode, we're going to go over an illustration of the sacred account because I want to provide a visual aspect on it. Because for me personally, I can hear information, but when I see it on the screen, it's much easier to digest. So that's what we're going to do today. We're going to provide an illustration. And if you have any questions, make sure you contact me. Make sure you drop a comment so I can help you out and digest this as well. So just to recap, last week we talked, provided just a foundation of the sacred account. We talked about how it's a store of value, and just so you know, it's a whole life insurance dividend paying policy, where you earn 3 to 5% on the policy, and then you only pay between 1 and 3% on the interest. Now, the reason why you pay 1 to 3% on the interest is because the insurance company at first will charge you, it could charge you 6% when you borrow. Now, you're probably like, how am I paying 1 to 3%? Well, here's the catch. When you pay yourself back, you lower the interest payment. Now, the interest payment is only due on your anniversary date. It's not due, they're not charging you interest each month. At the end of the year, there's an interest payment that has to be made. Now, you can pay it completely off before the interest payment is due, which means you save money on the interest, and you have that money again to use for paying off debt or investing. So that's how you lower the interest percentage. And let's just say you pay 2% on the interest and the dividend's 4%. Well, you still made a 2% profit on your money. So that's just something you want to keep in mind, and how that when you have a policy and you see that, like, wow, they charge me all in the interest. Well, you got to pay yourself back next. And think of it like a car. If you have problems with your car, you need to get maintenance done. Like, we all have to get maintenance done on our vehicles. It's the same thing with the policy. Maintenance needs to be done. You want to pay yourself back. Just like you have to get an oil change done, you have to get your tires looked at, or other mechanical problems in the car. You got to make sure it's all up to date. And just like your policy, you want everything to be up to date. Make sure it's used appropriately, and that you're maximizing everything in the policy. Now, I want to go over an illustration like I said earlier, so let me go ahead and share my screen with you. And let me just pull up this illustration so you can see what I'm looking at. So as you see here, this is what they call the Sacred Account Lite. Now, this is through Wealth Dynamics website, and I'll drop a link on that in the description so you can go check this out yourself. This stage of a person is when they are paying off debt, the Sacred Account Lite. This is how much they're contributing each month, and this is the annual amount they're going to be contributing every year. But they're doing it each month. Now, they can set this up quarterly or annually as well. So let's just say the person wants to put $3,600 in the account, but they want to do it annually. They can definitely just go ahead and drop an amount and just go from there. This amount is the cash surrendered value. This means that if a person wants to get out of their policy, the insurance company is going to say, hey, here's $2,681 to get out of the policy and cancel it, and you can be on your merry way. This right here is a death benefit. This is how much the insurance company is liable for. Now, the insurance company would rather pay you this, right? Because they're not going to be liable for paying your spouse or your loved one this death benefit. So, as you can see here, this is going higher and higher because of you're contributing to the policy, and this is how much you can take out. But remember, you would cancel the policy and lose your death benefit. So the insurance company would rather you take the cash surrender value and call it a day. Now, on this side, this money is growing at 3 to 5% each year. So I'm putting money in. I'm borrowing between 70 and 90% on my money, because the most you can borrow is between 70 and 90%. When I'm done borrowing, I'm paying myself back, right, while I'm still contributing. So let's just say I'm paying off debt. I not only save money on the interest that I'm putting in, but I'm also storing my value as well, and I'm also paying myself back from that old payment I made. So as you keep going down here, this is the break-even point. And let's go over to the bank side. I want to show you the same illustration, So here's the bank, right? This right here is the annual contribution. We're going to do the same amount, $300 for 10 years. As you can see, it's going up, going up. Now, the bank, the average interest that the bank will give you is 0.10%. So as you can see, you're not, making a lot on your money. Now, here's the difference between a bank account and a life insurance policy. As soon as I take money out from this amount, it's gone forever. The interest isn't going to keep growing. I'm not going to earn anything. Let's go back over to the life insurance policy. This money is still going to grow. The cash value that I put in is still going to grow. I'm still going to earn 3 to 5% on my money. Also, the death benefit is going to grow as well. That's another great part about having a whole life insurance policy is the death benefit is going to grow. And then as you can see here, let's just say I stopped contributing at year 10. Now what I did was, just so we can be on the same page, I added just a 4% dividend for each year. So every year, and again, this is just an illustration. This is not a guarantee because the insurance company, it's based on performance. But let's just say the insurance company makes 4% dividend on your, and you make 4% of the dividend each year. So you're making 4%, 4%, 4%, 4%, 4%, right? Let's go to the bank. 0.10%. So you're not even, by this year 15, you have $36,037. Over here, you have $43,823. Makes a huge difference, right? You're making more money. Not only that, if you ever take money out, let's just say you take $4,000 out to pay off a credit card, or you're trying to invest in something, that $4,000 is gone. If I take $4,000 from this money's still going to be growing at 3 to 5% each year. So no matter what's going on, like if I'm borrowing from this amount, it's still growing each year. It's never going to stop growing as long as I'm alive. And then also I have a death benefit over $190,000, $199 to be exact. This death benefit, $36,000. So as you can see, the death benefit is higher. My cash value is still growing because I'm earning a dividend. And then eventually, when I'm debt free, I have all this money to use and go and invest all of it. And when I invest in something, I am still contributing to the account. Now, again, this is an example. Let's just say I just stopped contributing to the policy. Obviously, you don't want to do that. But as you can see, the money is still growing. And on this side, you're making 0.10%. Now, the reason why people like to go with the bank is because they think it's more secure. But according to the FDIC Insurance, now that it means it insures the account that they would help with their deposits. They insure their deposits. Now, they only have 1% in their reserves, which means that let's just say the bank becomes insolvent. That means all their investments they put in, they're now out. What's going to happen is if you make more than $250,000, or if you have more than $250,000 in the bank, they're going to take that money so they can be solvent again. So the FDIC only covers up to $250,000. So if you're somebody who has $1 million in your policy, in the bank account, you're going to lose $750,000 just so the bank can be solvent again. Because in 2008, Congress passed a law where the banks can no longer get bailed out. They can't get bailed out from their bad decisions. Do you know every time you put money in the bank from your deposits, they're going to earn something on that, and they're going to take that money and invest it. That's what the banks are doing. So let's just say an investment goes bad and it crashes the economy and the bank doesn't have the funds to recover. They go after your account. But it has to be over $250,000. So if you have money sitting there, let's just say you have $700,000, they're going to take your money. They're going to take it and use it to get solvent. So that's why it's so important to understand where your money should be going. That's why you want to know, like, okay, why would I use life insurance? Because it's a tool that can protect your money. And we didn't even look at that illustration just showed you we didn't consider inflation. We didn't consider any market changes. We didn't consider any changes in the future with the dollar. That's just a basic breakdown of how money grows in life insurance versus a bank. So if you have any questions on this, if any of this is like overwhelming, I understand, because I remember when I first learned, I was like, whoa, what is going on here? Make sure you reach out to me. I definitely would love to chat with you, walk you through it again if you need help. But most importantly, guys, I don't care, like I said last week, I don't care what you use. I just want to make sure the vehicle I'm driving is getting me to my destination. And this vehicle is going to get me where I need to go financially. I'm going to use that vehicle all the time. It's a no-brainer. So it's not about I have a specific agenda or, you just don't want you just got to do what I say. No. I use this myself. And I've paid off all my credit card debt with life insurance. I've paid off $16,000. So what I'm doing is I'm paying off debt. I pay myself back, which I've been doing for the past 2 years. And then it's just a rinse and repeat. I'm not in the stage of investing yet. I'm in the stage of earning income and saving. It's earn, save, invest. That's what we want to do. We want to earn, save, invest. I just drew out a triangle. But that's how you want to look at it. But if you earn and skip to investing but never save, you're not solvent. You want to get solvent first. Because you have an emergency happen and you can't cover it, guess what you're going to do? You're going to have to take out a loan or a credit card. And you don't want to do that. Now you're stuck. So you earn, you save, you pay off all your bad debt first, because that's still going to hang over your head if you're trying to invest. So just take care of that first. If you have student loans, car payments, credit cards, collections, take care of that first. Get that all done. Because remember, the policy is still going to pay you 3 to 5%. So when you're done with all that, when you're out of debt, guess what you have left over? You still got savings in your policy. Now you can use that money to go start investing. So yes, it's a long-term perspective, and you got to look at that as a long-term goal. But at the end of it, you're going to be solvent. You're going to have more resources. And if there's an emergency that ever comes up, you have that covered. And then you're going to be debt-free as well. So if you have any questions, make sure you reach out to me. Make sure you also subscribe, like, and share this content. And I will catch you on the next episode.